This is Nightly Business Report with Tyler Matheson and Sue Herrera.
New highs, stocks soar, and tech shakes off a recent slide as investors wonder if this market is getting too expensive. A heated hearing. The Attorney General comes out swinging in testimony about Russia and Wall Street watches. Great Fed expectations. The central bank is widely expected to raise interest rates again tomorrow. So why aren't savers benefiting? Those stories and more tonight on Nightly Business Report for Tuesday, June 13th. Good evening, everybody, and welcome. I'm Sue Herrera. Tyler Matheson is off tonight. It is the 19th record close for the Dow this year and the 23rd for the S&P 500. A recovery in tech stocks from their worst drop of the year helped propel the broader market as well today. Investor attention turned to Washington. Both the testimony from Attorney General Jeff Sessions and the Federal Reserve's two-day policy meeting. More on those stories in just a moment. But first, here's a look at the numbers. The Dow Jones Industrial Average rose 92 points to 21,328. The Nasdaq advanced 44, and the S&P 500 was up nearly 11. And with stocks at or near new highs, a new survey shows that a record number of investors say stocks are overvalued. Bob Pisani has more.
The markets are back in record territory after snapping a two-day tech slump. But beyond tech, a broader debate is emerging over whether equities overall are overvalued. Bank of America released the results of its global fund manager survey today, and 44% of respondents said they think the stock market is expensive. That's the highest level ever. Roughly 50% believe the global profits will continue to improve. That's good news, but it suggests that the markets are vulnerable to profit weakness down the road. You might think that the biggest risk in investors' minds is the potential for a big sell-off in tech. That's the big mover. But that's not even close. China's tightening credit problem is by far the biggest risk, managers believe, followed by the risk of a crash in the global bond markets and then a delay in tax reform in the U.S. Might be surprising to see tax reform delays assigned such a low number on the risk scale. You might think the Trump agenda is the primary phenomenon underpinning the rally, but fund managers don't seem to think so. So with tech stocks the big winners this year, it's no surprise fund managers say that the tech-heavy Nasdaq is the single most crowded trade, followed by European equities. Finally, what would it take to kill the equity rally? A lot of equity traders are still worried about a sudden rise in bond yields. 64% said it would take 10-year Treasury yields to move to 3.5% to 4% for an equity bear market to start. We're a long way from that one. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The bank stocks also got a lift after the Treasury Department released a broad plan to change the rules regulating the financial sector. The report calls for streamlining rules on big Wall Street banks, as well as small and medium-sized banks. Among the recommendations, a restructuring of the Consumer Financial Protection Bureau, scaling back the Volcker Rule, which bans banks from engaging in certain types of risky investments, paring back the annual stress tests on banks to twice a year, and modernizing the Community Reinvestment Act. The report wants to look at that law and how it can better meet its purpose. As a result, most of the bank stocks rose in today's trading session. Investor optimism is indeed fueling the overall stock market, albeit a shrinking one. And that is because there are fewer than half as many stocks to choose from than there were just 20 years ago. Today, there are about 3,600 listed companies compared to the 7,300 back in the late 1990s. Mark Lehman, president of JMP Securities, and Todd Rosenbluth, director of ETF and mutual fund research at CFRA, join us now to talk about what this winner-takes-all market will mean for you. Welcome, gentlemen. Nice to have you here.
Thanks, Sue.
Mark, let me start with you. How dangerous is this for the individual investor, or concerning is it for the individual investor?
I think for the individual investor, the fewer choices that you have obviously is an alarming thing to think about. But I think also for the individual investor, over time, it's always been tough to own individual stocks. I think owning a broad portfolio and owning mutual funds and other ways to be a participant in the market as opposed to a narrow list of stocks has always been a good idea. And this narrowness is only inflated by what you just described, which is the number of equities that are available to be bought. I still think a broader portfolio and spreading your risk amongst equities is a much better idea than owning individual stocks for most investors.
And Todd, we'll get to that point about individual stocks in a second. But one of the other factors is, of that shrinking pool of stocks, an even smaller number of stocks control most of the revenue that is generated by those companies. So argue the individual stock portion of things compared to the broad exposure you could get from an ETF.
Yeah, so we're big believers that past performance isn't indicative of future results, but what we've seen is that individual active managers struggle to keep up with the benchmark. Just this year alone, about a third or less than a third of those active managers are outperforming the S&P 500 index. High fees play a role into that, but an index-based approach from an iShares or a Vanguard or a State Street product offers great diversification in a low-cost structure that is appealing to many individual investors.
Mark, do you think that that will change, not the indexing, but the number of companies that choose to list? I mean, there are many reasons why we're seeing a shrinking pool of stocks. Some of it is M&A, some of it is the IPO market has dried up. Do you see this situation changing at all or not?
It's slightly better, Sue. I mean, this year's been a much better year in terms of number of IPOs for the first 5 months of the year. And secondarily, the performance of those IPOs has been quite good. And nothing helps an IPO market than performance. And there's also that kind of demand pull from investors. It's not to any level like we saw back in the 90s, early 2000s. But usually demand and performance reigns supreme. The other thing I'd point out is there was this kind of infinite amount of capital, and still is for some of the private companies, and some of the companies that have decided to stay private longer. Uber, which is obviously on the cover of everybody's newspaper today, has stayed private much, much later than any company could have or would have stayed public 20 years ago. And maybe some of the news of today and some of the illiquidity that some of the investors has may push towards an IPO for some of those companies as opposed to staying private longer.
Mark, let me stay with you. If you do decide to pick individual stocks, you know, one of the problems is with the smaller pool, you're getting in with everybody else, which drives up the stock price, which leads people to think that, well, maybe this stock is too rich. Can you work around that phenomenon or not?
Well, if you're going to check individual stocks, obviously, you got to be good. You got to be really, really patient, and you got to really find the kind of companies that have the kind of expanding marketplace that some of the big winners that you've talked about have. I think you got to be very, very cautious, though, because owning individual stocks is fraught with peril. But there clearly are these winners that we've talked about. And although a lot of people are out there talking today about how expensive they are and what time to worry,
right.
People have had these conversations 6 months ago, a year ago, 2 years ago, and guess what? Those stocks have outperformed the market because the fundamentals and the end markets are that big.
Todd,
so I think you really got to watch what you're investing in over the long term.
Very quickly, if you were to pick a broad-based ETF that perhaps would fight the phenomenon that we've been talking about, where would you put your money?
Yeah, I mean, you could go into one. I think you can go with well-diversified ETFs like IVV or VOO. You certainly can go with a more value slant to what that is, so that holds stocks that have not risen as much. So IVE, which is an iShares S&P 500 value ETF, is a good way of going. Instead of piling in to the Apples, the Googles, the Facebooks, you can get diversification with a number of stocks in a very low-cost manner.
Gentlemen, thank you so much. Mark Lehman, Todd Rosenbluth, we appreciate your perspective. Inflation pressures appear muted after a rise to start out the year. The Producer Price Index, which measures prices that businesses receive from customers, was unchanged in May as energy costs recorded their biggest decline in more than a year. Though prices were flat from the prior month, they did advance nearly 2.5% from a year earlier. And that report on inflation comes as Federal Reserve policymakers meet to discuss the direction of interest rates. A decision is due tomorrow. And it's something that investors, money managers, and economists will be watching closely. And Steve Leisman surveyed them to get a sense of what they think about the Fed and the market.
The CNBC Fed Survey ahead of the Federal Reserve's meeting shows 100% of our respondents expect a Fed rate hike tomorrow at the meeting. 54% say that third rate hike this year will happen in September. and 64% say the balance sheet will begin to decline by December. That's quite a bit earlier than was believed earlier this year. Looking at the outlook for the Fed funds rate, you can see the 3 rate hikes in there this year, up to 1.4%, 2.1% in 2018, and then a little bit more modest in 2019, leading up to 2.8%, which they believe is a terminal rate. And that's just a bit below where the Fed's own forecast is for 2019 and for the long run. Kind of pessimistic, though, when it comes to the stock outlook. 24.29 is the current level, going up to just 24.42 for the rest of this year. So they think most of the gains are in this year, but a little bit more for end of 2018, up to 25.62 or 5%. But some optimism as to the reasons why stocks are at current levels. Earlier this year, 82% thought it was expectations for fiscal policy from the new Trump administration. That's come way down, just 29%. 63% now believe that what's underpinning markets are economic fundamentals and earnings. Now, when it comes to the outlook for growth, that's come down a bit, in part because they factored out policy expectations. Was 2.5% in January. It's come down by 1/4 point to 2.25%. For 2018, it was 2.75. It's now 2.45%. And you can see the reason in the next graphic. How much growth was factored in from policy stimulus? It had been 1/4 point, almost all gone for 2017. 40 basis points was factored in from Trump policies for 2018. Now that's just 0.2%. And what that reflects is an expectation that if there's going to be fiscal policy, it's going to happen next year, not this year. For Nightly Business Report, I'm Steve Leisman.
And if the Federal Reserve does hike interest rates tomorrow, it will be the 4th time in this rate hike cycle. But savers aren't yet benefiting from that. We'll take a look at why a bit later in the program. Traders were watching the late afternoon hearing on Capitol Hill, where Attorney General Jeff Sessions testified on Russia, and he was fiery from the get-go.
The suggestion that I participated in any collusion, that I was aware of any collusion with the Russian government to hurt this country, which I have served with honor for 35 years, or to undermine the integrity of our democratic process, is an appalling and detestable lie.
John Harwood is in Washington for us tonight. John, he answered some questions, but he refused to answer others. So did we learn anything new? What was the big takeaway?
Not a lot new. It wasn't like James Comey's testimony last week. What we saw from Jeff Sessions was, as you played in that clip, a very emotional defense of his honor, his patriotism, his integrity. Defended himself more than he defended President Trump. He provided some additional detail about how he says he responded to James Comey when James Comey expressed that he was uncomfortable with a meeting the previous day with the president. He affirmed part of Comey's statement, which was that there was a meeting on the 14th of February, that the president did have everyone else leave the room other than James Comey so he could be alone with the president. However, Jeff Sessions refused to say whether the president had ordered everyone else to leave, or refused to characterize in any other way the president's statements to him about why he fired James Comey. So there was a mix, and some of the senators were frustrated.
Yeah, they did seem frustrated. How did this compare in general to the FBI director's hearing last week? We certainly seem to learn things in that testimony that we did not know before.
This was a lot more partisan session with Sessions. The Democrats were pressing him. They felt that he misled Senator Al Franken during his confirmation hearing about saying that he had not had any communications with the Russians. Senator Sessions somewhat angrily responded that he was saying in context to the question Senator Franken asked, he was responding accurately. And Republicans were very strong in defending their former colleague. People like Tom Cotton and John Cornyn and others were standing up for Jeff Sessions, so did Jim Risch of Idaho. So it didn't advance the ball that much on the investigation. The big takeaway was Jeff Sessions saying, I'm an honest guy and I didn't collude with the Russians. I have to add, though, that Jeff Sessions had not been accused of colluding with the Russians. There had just been questions raised about his contacts.
Indeed. John, thank you. Appreciate it. John Harwood in Washington. Still ahead tonight, OPEC promised to hold its production cuts, but that appears to be easier said than done. One health insurer is doing what most others are not. It's planning a broad expansion of its Obamacare offerings next year. Centene plans to sell plans in 3 additional states: Kansas, Missouri, and Nevada. It will also expand in 6 states where it already sells Affordable Care Act plans. Aetna, Humana, and United Healthcare have largely quit the Obamacare markets. North Dakota's oil production rose in April, complicating OPEC's attempts to stabilize the global energy market. And North Dakota isn't the only one. Jackie DeAngelis explains.
OPEC promised to hold its production cut through the first quarter of next year, but it looks like some cheaters are emerging. The oil cartel's monthly report confirming that production was up in May from April, an increase of a little less than 500,000 barrels a day. Libya, Nigeria, Iraq, all boosting output. OPEC also thinks U.S. production will rise year over year due to the increase in shale production, a little less than 1 million barrels per day. Can demand increases absorb the excess oil? Not exactly. OPEC sees demand rising year over year, but only a little more than 1 million barrels a day. That's not a lot.
I think prices will go lower from here. 45 is a critical level for crude oil, and we tested that this week. So if we get below $45 a barrel, then the market is going to say OPEC is not abiding by its own cuts. We always had doubts about whether or not this would hold, and we see that everybody now, it looks to be cheating. It's tough to see how we don't revisit some of the more recent lows, say $40 a barrel.
But there's a reason OPEC didn't play all its cards at the last meeting. It could make deeper cuts from the more cash-rich countries like Saudi Arabia. The Saudis said they'll hold back some additional exports to the U.S. and Asia in July. It could help, but some argue it's not enough.
I don't see any reason that the Saudis are going to cut production. They have to fund all of their social programs. We know that Saudi Aramco wants to come to market with an IPO. They want to show as much production as possible. They want to show as much revenue and net earnings as possible. I don't see how Saudi Arabia would decide to be the hero among the OPEC countries and cut while everybody else is cheating.
Crude isn't moving as it usually does this time of year. Less robust driving demand in the U.S. is another problem for prices. AAA says the national average for a gallon of regular is $2.33. That's down a nickel from a year ago. For Nightly Business Report, I'm Jackie DeAngelis.
Cost cuts help results at H&R Block, and that is where we begin tonight's market focus. The tax preparation company also said promotions and impactful marketing helped it grow profit, while a drop in tax returns caused revenue to remain flat. The company also hiked its quarterly dividend by 9% to 24 cents per share. H&R Block shares were initially higher in after-hours trading, adding to a 2% gain during the regular session, where they closed at $26.99. Sears is cutting about 400 jobs in an effort to cut costs and turn around its struggling business. The retailer said the layoffs will come from the company's headquarters and support functions. Shares were off by more than 2.5% to $6.85. Cheesecake Factory blamed bad weather for its outlook being cut for the quarter. The restaurant chain said it now sees same-store sales falling 1%. The company also said it expects the new forecast to negatively affect margins and earnings. Shares fell nearly 10% to $52.58. And the lawn and garden company Scotts Miracle-Gro also blamed poor weather and is cutting its guidance, but for the full year. The company said tighter inventory management, changes in merchandising strategies, and bad weather in its core market hit its sales, and the company now expects sales and earnings to come in lower than expected. Nonetheless, shares rose a full 7% to $89.83. As we mentioned earlier, the Federal Reserve is expected to raise interest rates for the 4th time tomorrow. Since it began its rate hike cycle back in December of 2015, savers have gotten nothing. The yield on the traditional savings account and CDs have remained relatively flat. So at what point will savers start to see benefits from rising rates? Scott Brown is the chief economist at Raymond James, and he joins us now to talk about that. Good to see you, Scott.
Nice to be with you.
You know, it seems that rates are always going up on adjustable rate mortgages and credit cards, but they don't seem to be going up on CDs and savings accounts. Why is that?
Well, deposit rates have always lagged the Federal Reserve rates on their way up. That's just the way it is. Banks aren't particularly competing against themselves very aggressively at this point to attract deposits. Over time, we should see a gradual increase, but bear in mind that this interest rate path that we're on now from the Fed is a lot shallower than past cycles. We've had two increases in the last 2 years, two this year, counting the one expected tomorrow. But this is a very slow pace, so we don't really see deposit rates rising very rapidly. So that's a bit of a problem for savers.
Yeah, it is a problem for savers, and I think you make a very interesting and good point, because for those of us who remember when interest rates were going higher at a more rapid pace, you did see CD rates that were much more attractive for savers, and that's not the case now, partly because of some of the economics in the economy as it stands.
Well, also, yeah, we're looking out in the future, and one of the interesting things about tomorrow's Fed meeting is that we're not just looking for what the Fed is going to do with interest rates, but what sort of signals we'll get about the pace of future rate increases. And we've got this division now going on between the market, which seems not to be expecting a whole lot more from the Fed. Maybe about a 50% chance that they may end up raising rates once more by the end of the year. In contrast, we get every other Fed meeting this dot plot, which is the expected year-end federal funds target rate for each of the forecasts from each of the Fed officials. And those dots are not really likely to move too much, and that implies that the Fed is still looking for probably 2 to 3 rate increases in each of the next couple of years.
You know, it's interesting that we're not seeing more competition, is it not, between or among the various banks out there for consumers' money? I mean, we saw Goldman Sachs come out with a much higher rate offered on some investment products than others. Would you expect to see, as the Fed starts to increase rates, more competition?
I think you may see a little bit more, obviously, with this latest rate increase. And typically what happens is that one bank will raise its deposit rates and others will be forced to follow to remain competitive. But again, I don't think there's a whole lot of upward pressure in the short term. This is likely to happen over a period of time. But even still, when we look at the end result, we're looking at the Fed probably ending this tightening cycle at a much lower rate than we have in the past. So investors are still not going to get rich on their savings and checking accounts. They may end up earning a little bit more money than they have in past years, but it's not like it was a couple years ago, and that's largely due to the demographic changes, the slower labor force growth.
Absolutely. Scott, thank you so much. Scott Brown with Raymond James.
My pleasure.
Coming up, Game On. What the video game industry is betting will be the next big thing. Uber's CEO is taking a leave of absence. Yesterday, we told you the move was likely, and today it was made official. What's not clear is how long Travis Kalanick, who also founded the ride-hailing company, will remain away. His direct reports will run that company. The decision follows an investigation into sexual harassment at Uber and a list of recommendations to improve the company's culture. Those recommendations include the addition of board seats, an oversight committee for issues related to diversity and ethical practices, and the prohibition of romantic relationships between employees and superiors. The video game industry is always looking for the next big thing, and players are always looking for the next big game. The two groups are converging at the biggest video game event of the year, and Julia Borston is there.
E3 is drawing around 55,000 gamers and industry executives here to the Los Angeles Convention Center to check out the latest gaming hardware and software. The biggest console announcement this year is from Microsoft.
Today, we're proud to welcome the newest member of our Xbox family, fittingly named Xbox One X.
The new console costs $499, $100 more than Sony's comparable PS4 Pro, but it features higher definition graphics.
If you want the ultimate, you want the best in gaming, the most powerful console, and gamers want the most powerful console, you want the true 4K gaming, the only place to play that is Xbox One X.
Sony unveiled a number of new games, but no new console. Its PlayStation 4 continues to dominate. Sony announcing that the PS4 has sold over 60 million units with 26.5 million subscribers to its PlayStation Plus service.
It's not just the console makers looking to that kind of subscription revenue. Game makers have also shifted their focus away from the one-time sale of a game to ongoing digital transactions.
One of the games Electronic Arts unveiled, its new Star Wars Battlefront 2, which features low-cost virtual goods to drive what's called microtransactions, which add up to an increasingly important source of revenue. EA and other game makers are also investing in esports to keep their gamers engaged.
We're bringing esports to Battlefield. Again, 20 million players. We're bringing new maps, a whole esports component to that game. And so we think it's going to be a meaningful thing for us.
While there are always plenty of VR demos here, that virtual technology still hasn't tipped to the mainstream.
This is not hundreds of millions of people experiencing VR, and this is not the year it's going to, hatch into a big chicken.
But with game stocks, including Activision Blizzard, Take-Two Interactive, and EA, trading near all-time highs, investors think there's plenty of room for the industry to grow. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And before we go, here's another look at the 19th record close for the Dow this year and the 23rd for the S&P 500. Today, the Dow rose 92 points, 21,328. NASDAQ advanced 44, and the S&P 500 was up nearly 11. And on that bullish note, that's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening. See you tomorrow.